Okay, let's dive into this. Because, what we're looking at today isn't just another passing headline about oil prices or stock market jitters. We are unpacking a fundamental, massive restructuring of global power, the US dollar and China's strategic maneuvering. We're literally talking about a shift in how the world's financial plumbing operates from the ground up. In this explainer, we're going to break down exactly what is happening with the petrodollar, step by step, and why it holds absolutely enormous stakes for your everyday life.
The United States recently received a direct warning from the United Arab Emirates, one of its most consistent allies in the Middle East. The UAE signaled that if they run low on dollars amid the regional conflict with Iran, they may be forced to price their oil in Chinese yuan. They also noted they could begin liquidating their portion of the $2 trillion in American assets held collectively by the Gulf states. In response, Treasury Secretary Scott Bessent agreed to provide these nations with dollar swap lines. These are essentially credit lines from the Federal Reserve, designed to ensure the UAE has immediate access to dollars without having to sell off what they already own. The Treasury's stated goal for these swap lines was to prevent the disorderly sale of U.S. assets. And this move highlights a specific vulnerability. The U.S. is now providing specialized financial lifelines to prevent its own allies from potentially destabilizing the American bond market. This raises a question about the current state of global power. How did a system designed to give the U.S. influence over its allies result in a scenario where those same allies can now use their holdings to influence U.S. policy? The roots of this dynamic go back to 1974. Following the end of the gold standard, Secretary of State Henry Kissinger negotiated a deal with Saudi Arabia that would form the backbone of global trade for the next 50 years. The agreement was straightforward. Saudi Arabia would price its oil exclusively in U.S. dollars. They would recycle those dollars into U.S. Treasury bonds, acting as a consistent lender. In exchange, the United States provided military protection and advanced weaponry. This arrangement created a structural demand for the U.S. dollar. Because every nation required oil to function, every nation had to maintain a supply of dollars, effectively tethering the global economy to the U.S. financial system. That system functioned without major challenge until 2022, when the U.S. froze $30 billion of Russia's foreign exchange reserves. It was a clear demonstration that the U.S. was willing to use the dollar as a tool of foreign policy. Central banks around the world took notice. Fearing their own reserves could be targeted in future disputes, many began shifting their holdings out of U.S. treasuries and into physical gold at a pace not seen in decades. While the U.S. remained focused on the financial markets, China moved to secure the physical economy. They established yuan clearing banks in major trade hubs and secured a majority share of the mining and processing for rare earth minerals, the materials required for modern military hardware. By utilizing the dollar as a weapon, the U.S. provided its competitors with a reason to accelerate the development of an alternative financial plumbing system that bypasses American oversight. The current crisis began when the war with Iran spilled into the Strait of Hormuz. Iran closed the narrow waterway that handles roughly 20% of the world's oil and gas supply every day. This closure created a revenue crisis for the Gulf states. With their primary export route blocked, countries like the UAE and Saudi Arabia are forced to spend their dollar reserves to maintain their domestic economies, leaving them with less capital to support their currency pegs. China's alternative system now offers these states a way out. By signing new trade deals with Beijing, the UAE is signaling that it no longer has to rely solely on the dollar-denominated system to survive an energy crisis. The relationship has reached a new stage of negotiation. The Gulf states are using their potential shift toward the Chinese yuan as a tool to secure financial concessions and liquidity from the United States. This shift has introduced a new constraint on Washington. U.S. policymakers must now weigh their geopolitical goals against the immediate reactions of the bond market. Analysts point to a threshold in the 10-year Treasury yield. At 4.4%, government borrowing costs threaten economic stability. Recent patterns show a correlation. During military posturing, yields rise toward 4.4%. When diplomacy resumes, yields recede. It appears that America's high debt levels have created a real-time feedback loop. Financial stability is no longer just an economic goal. It is a factor that the administration must manage alongside its military and diplomatic objectives. The U.S. Treasury's decision to offer swap lines provides short-term stability for the bond market, but it does so by increasing the supply of dollars at a time when global trust in the currency is already being tested. Meanwhile, the fiscal crisis remains. With the Strait of Hormuz obstructed, the supply of fuel and fertilizer is tightening. These supply-side constraints suggest that inflationary pressures may persist regardless of what happens in the financial markets. This is reflected in the adjusted Buffett indicator, which compares the total value of the stock market to the GDP after subtracting federal debt. Currently, this indicator is moving into the same danger territory seen during the dot-com bubble and the 2021 peak. Despite these geopolitical and inflationary risks, the stock market remains near record highs. It is currently operating on the assumption that regional conflicts will resolve quickly and that a productivity boom will offset rising costs. The era of the petrodollar as a one-sided lever for American power is changing. As the world moves toward a system where commodities and physical resources hold more weight, investors should move away from broad optimism.
Which leaves us with this final, crucial thought to end our explainer on. The market right now is incredibly, overly optimistic. It's pricing in perfection, all while the foundational 50-year-old petrodollar system is visibly fracturing right in front of us. So, in a world that is steadily shifting away from infinite paper currencies and moving back toward finite, hard resources, where are you parking your trust and your money? It's a question every single investor needs to ask themselves today. Thank you so much for joining me for this explainer, and definitely keep your eyes on these global shifts.